Good afternoon to everyone attending from the East Coast, and good morning to people who've joined us from Western Australia. First, we'll look at some rates and thresholds that apply to the current FPT year. We've included the relevant rates and thresholds for the 2024 year so that they are easy for you to find. We will not go through them individually, but a few things to note here is the significant increase in the benchmark interest rate and the introduction of a cents per kilometer rate for electric cars. Not-for-profit entities are also entitled to concessional FPT treatment subject to some capping thresholds. There is a $17,000 and a $30,000 exemption cap depending on the type of organization, and there is a $30,000 rebate cap for registered charities and religious institutions, public education institutions, and certain not-for-profit organizations. So benefits up to these caps are either exempt or eligible for a rebate. In addition, there is a 50, sorry, not 50. In addition, there is a $5,000 meal entertainment and entertainment leasing facility cap that is also available to not-for-profit entities. It is important to note that these caps represent the grossed up value of the benefits, so the actual cost of the expenditure subject to these caps is much lower. Also, it is worth noting that certain benefits are not counted in the capping limits. Examples of such benefits are car parking and non-salary sacrifice meal entertainment benefits. This means that a public benevolent institution can, for example, provide unlimited car parking benefits to its employees and not pay any FPT on it. Moving on to some recent updates. Electric cars have been a favorite topic for FPT in the last 2 years. Just to refresh our memories, electric cars are not subject to FPT from 1 July 2022 if certain conditions are satisfied. To access the exemption, the electric vehicle must meet the definition of a car under the FPT legislation. So the exemption does not apply to electric motorcycles, e-bikes, or vehicles designed to carry a load of greater than 1 ton. The vehicle must be a battery electric vehicle, hydrogen fuel cell, or a plug-in hybrid car. And the price of the car must be lower than the luxury car threshold. It is important to understand that not all the portion of a car's costs is included in the calculation of luxury car threshold. Costs such as stamp duty, service plans, and finance charges are not considered for luxury car threshold purposes. I have been thinking of getting one myself, so I thought of getting a quote for a BMW iX3. My initial thought was BMW expensive above the luxury car limit. But as you can see, despite the car's costs being more than $92,000, it still qualifies for the FPT exemption as the cost of the car for luxury car tax purposes is only the GST inclusive price, which in this case is just north of $87,000. For many electric cars these days, you can upgrade a lot of software after you've purchased the car. For example, you can get autopilot, auto driving feature in the Teslas after you've purchased the car. If you did so, anything you pay for afterwards does not get included in the cost of the car for luxury car tax purposes. So there's a bit of playroom in that threshold. We did some high level calculations. On an average, one can save between $10,000 and $12,000 in tax each year when they package an electric car. This is by far one of the best tax saving opportunities available in the FPT space with very little obligations on the employer. So any organization not currently allowing staff to salary package electric cars should consider offering this to their staff members. We will now launch a poll question. This is our first poll question for the session. I know that The FPT implications of an electric vehicle is a very new concept, but have a go at answering this question. For an FPT exempt electric vehicle, do you need to worry about including recipients' contribution in the calculation? Option A, no, it's an exempt benefit, don't worry about it. Option B, yes. And just so everyone can have a go at answering, option C, unsure. Moving on to the next one. The ATO has issued a practical compliance guide which provides a 4.2 cents per kilometer rate for using electric cars when they are charged at home. So if you have outright purchased the electric car, you can use this rate to claim a reimbursement for work related use of your car or a tax deduction, or you can use this right to calculate a tax deduction in your personal tax return. Where your car is obtained under a novated lease arrangement or has been provided by the employer and you seek a reimbursement, you can use this right to calculate your reimbursement, and the amount reimbursed should not be subject to FPT because it's considered as a running cost of a car. And if you don't seek a reimbursement, you can calculate an amount using this rate, and this will be your employee contributions, which will reduce the reportable fringe benefit amounts. Something to be mindful of with electric cars is that whilst it's an exempt benefit for FPT purposes, it is nevertheless a reportable fringe benefit that needs to be disclosed in an employee's income statement for the year. Any in-home charging equipment is a separate benefit. So if it has been packaged or provided by your employer, it will be looked at either as an expense, property, or a residual benefit. Records such as logbooks and odometer recordings should be maintained in order to use the cents per kilometer method as per the ruling, as per the practical compliance guide. It is worth noting that this guideline only applies to cars and no other electric vehicle types. So if you have an electric bike or an e-scooter, you cannot use this right. We will now launch a second poll just to get you guys thinking about employee contributions because they are important for managing the reportable fringe benefits amount. So when preparing the FPT return, how do you calculate the recipient's contribution for an electric vehicle given the car is largely charged at home using rooftop solar? Option A, cash contributions made by the employer. Option B, cash contributions plus servicing costs and commercial station expenses that you incur while charging the car at the commercial station. Cash contributions and ATO cents per kilometer ride. All the above. And last option for everyone, unsure. I think a majority of us have answered all the above. So pat yourself on the back because you've answered that. So in in terms of employee contributions or recipients contribution, you can claim for anything that the employee has paid for by themselves. So if they've incurred some money at the public charging stations, you include that, any servicing costs, everything that you paid. And if you've driven the car by using it, by charging it at home, you calculate the amount of employee contributions using the ATOs, right? The next topic relates to a pain point that everyone who's involved with collecting declarations may have experienced. Employee declarations are required to reduce the taxable value of benefits for various concessions, and these must be collected before the lodgement of the FPT return. Currently, there are about 20 declarations prescribed by the ATO on their website. The Commissioner has acknowledged that some of these declarations are doubling up on the records that you already have in place. So he has issued determinations for various benefits, which provides that employers don't have to obtain employee declarations if sufficient information is obtained from alternative records. We'll not spend a lot of time on this, but just something that you should be aware of if you are looking for process improvements. There is no prescribed number of alternative records from which the information should come from. The information can come from any number of sources. Some of the examples of acceptable alternative records are listed on the screen to give you an indication of the variety of sources from which the information can come from. Next one's around self education expenses. Now, employers quite often provide staff with education and training or allow staff to salary package self education expenses. Therefore, to access the otherwise deductible reduction, it is important to ensure that the self education expense is income tax deductible. If it is not, then any reimbursement by the employer is potentially subject to FPT. The ATO have this year released a tax ruling which sets out the principles on deductibility of self education expenses. Again, we will not spend a lot of time on this as the ruling does not introduce any significant changes. It just reflects the removal of the $250 non deductibility threshold and provides lots of examples for greater clarity. Nothing new here, just says that the self education expenditure should relate to the income earning activity and the skills acquired should not be too general in nature to get a tax deduction for the expenditure. And you cannot get a deduction if the expenditure is to gain new employment or if the income earning activity stops. For example, if you take a career break. Now we'll discuss or recap on some of the basics of FPT for some common benefits that we see. First one being cars. Now, a car fringe benefit arises when a car is owned or leased by the employer. Now, car is defined within the FPT legislation. So, a car is defined as a vehicle that is designed to carry a load of less than 1 ton and fewer than 9 passengers. So, if a vehicle does not meet this definition, it does not qualify as a car for FPT purposes. It excludes goods carrying vehicle even if they are designed to carry a load of less than 1 ton. For example, single cab vehicles. Now, if a vehicle does not qualify as a car for FPT purposes, it means that it's a residual fringe benefit and there is a different valuation methodology to it. Now, these residual benefits or vehicles that don't qualify as cars, the benefit of these vehicles are ordinarily home to work travel is considered private. However, if certain conditions are satisfied, the home to work travel in a residual vehicle is considered as business travel. So that's why it's a very attractive vehicle for employers to give to employees. Now, with an electric car, it has to satisfy certain additional criteria apart from being a car. Has to be a battery electric vehicle, hydrogen fuel vehicle, or a plug-in hybrid electric vehicle, which is exempt until about 1 April 2025. Has to be first used on or after July 2022 and should have not been subject to luxury car tax at any time. It is important to note that motor vehicles other than cars are not eligible for the FPT concessions for electric vehicles. Now, there are two ways to calculate the taxable value of a car fringe benefit. The simple way is the statutory formula method, where you pick up the base value of a car, which doesn't include a lot of things that you pay to purchase a car, for example, stamp duty, registration costs, and things like that. You multiply that by the statutory percentage, which these days is flat 20%, and apportion it by the number of days the car was available for private use. And the result of that formula, you take off any recipient contribution from that, and the answer is the taxable value of the car under the stat formula method. I'll come to recipient's contribution in a minute, but the other method is the operating cost method, which takes into account total operating cost, like all the running costs of the car. If your car is owned by the employer, it includes deemed depreciation and deemed interest as well. Multiply that by the percentage of private use and take off any recipient's contribution from the number. Something to bear in mind that FPT is payable at the top tax rate of 47%. So if your employee is not on the highest marginal tax rate, you will always be better off paying an allowance to the employee and getting them to make an after tax contribution. So their overall tax exposure would be a lot less than what you would be paying under the FPT rules of 47%. We have run these post tax contribution programs for a lot of clients where the overall tax exposure was significantly reduced as a result of these strategies.
Oh, Rahul, I might just jump in again. Just when people deciding whether they should use the statutory method or the operating cost method, obviously there's administration burden on operating cost because you need to keep more records. But what we find is that generally, if your business use is around the 80% mark, you're clearly going to get a big advantage by using operating cost. There's probably a break even where the business use is probably around that 40 to 50% mark. Thanks.
Thank you, Stephen. Here are some of the practical compliance guides that can be relevant for this year's FPT return. The first one is in relation to motor vehicle other than cars, where you can use the Commissioner's safe harbor to assess whether a car's use qualifies as minor and infrequent. Again, just refreshing, for a home to work travel in a residual vehicle to be considered business, the overall private use of the vehicle should be minor and infrequent. The Commissioner's practical compliance guide gives you some conditions that you satisfy, then you can rely on the safe harbor. Second one is where you are unable to obtain all the logbooks in a fleet. Then you can use the average business use percentage if you satisfy certain conditions. The one downside to this PCG 2016/10 is where employees have got a very high business use percentage, for example, 100%. And if you choose to use the average business use percentage, that employee would ordinarily not expect a reportable amount in their income statement. But as a result of using the average business use percentage, you may have some reportable fringe benefit amount in their income statement. So something to be just mindful of, that if you're using the average business use percentage, somebody who has 100% business use of their car may end up with a reportable amount on their income statement. Last one is for the cents per kilometer rate for an electric vehicle. Next, we'll discuss car parking fringe benefits. Now, most not-for-profit organizations would not have a car parking fringe benefit. So please look away if you are a registered charity, public education institutions, hospitals, or ambulance services. This section is for attendees from the government departments and portfolio agencies. Now, for a car parking fringe benefit to arise, first of all, there must be a car that has to be parked at the spot. Now, car, as we said, is defined in the FPT legislation. So if you're parking a single cab ute on a parking spot, it would not give rise to a car parking fringe benefit. Car parking provided to employees who are disabled are also not subject to FPT. Now, a car parking fringe benefit can arise where certain conditions are satisfied. The car has to be parked on the premises owned or leased by the provider. It should be parked within the primary place of employment and has to be parked for at least 4 hours between 7 a.m. and 7 p.m. So if I drove into work, parked my car, and took the car to a client's office and spent the entire day there, that day I would not have a car parking fringe benefit because I parked for less than 4 hours. The car must be used to travel to and from work at least once on that day and used on that day to travel between home and work. And the most important one is the existence of a commercial parking station available within a 1 kilometer radius that charges more than the commissioner's threshold for their year. If you have significant exposure on car parking benefits and if you use the actual method, you should consider if your records can give you information on whether a car park has been used for less than 4 hours, or now that most of us work a few set days from home, which employees were working from home and did not travel to work on specific days. Now, as we said, for the car parking fringe benefit to arise, there has to have a commercial parking station within a 1 kilometer radius. Historically, the ATO have accepted that a car park that had a free period or a low hourly rate but impose a penalty rate for all day parking was not deemed to be a commercial car park. This generally applied to most shopping centers and hospital car parks. However, following the Qantas and the Virgin cases, the ATO has released a tax ruling which significantly broadens the definition of a commercial parking station and now includes shopping centers and hospital car parks as commercial car parks for threshold and valuation tests. So, this ruling provides that the employers are required to determine and reasonably conclude whether a car parking facility is a commercial car parking facility by applying the following two tests. First one is whether a car parking facility is run by a car parking operator. If it is the case, then the facility is considered a commercial parking station for FPT purposes. Otherwise, if the car parking facility is not run by a commercial operator, the ruling provides that if there is clear signage, entry and exit restrictions, or if the facility charges more than a nominal fee, the facility will be a commercial parking facility. So it just opens up a massive definition for commercial parking station. Now, there are two parts to calculating the taxable value of a car fringe benefit. One's to work out the daily rate, which is the valuation method. There are three options. Commercial parking station method, where you go and find out the nearest commercial parking station and assess what rate they are charging. Market value method, where you don't have any commercial parking around your spot. So you obtain a formal valuation to decide what is the value of the benefit that you provided, or you use the average cost method, which is simply picking up the rate at the start of the year and at the end of the year and dividing that by 2. Once you've decided the daily rate, then you calculate the annual taxable value. Again, you've got another three options here. 12-week register method, which works out the pattern of use over a particular time, and then you use that rate you use that pattern to calculate the taxable value. Statutory formula method, which takes into account 228 days of the year, which assumes that you've given the car parking spot to employees for about 228 days of the year. Last one is the actual method, which assesses how many days actually you provided the car parking spot. Now, if you've got employees who are salespeople who are mostly on the road, then the actual method may be beneficial to you. Whereas if you've got employees who are just office employees, like finance department, who come into work 48 weeks of the year, then statutory formula method will give you a better outcome. So there are a few options there depending on which one works better for you.
Rahul, I might just jump in again. Just
Yeah.
on the valuation method, we find that look, when people have more than 10 car parks, quite often that valuation method is the best one. And there's another option where there might be an annual rate or a monthly rate. You can actually divide that by the number of days in the period. And sometimes that's better than those daily rates, and you can use that as well. So there are some things to look out for.
Next one's entertainment, our favorite topic. So look, entertainment is the provision of entertainment by way of food and drinks and any accommodation or travel in connection with it or to facilitate the entertainment. For example, if you took a taxi to go to the entertainment event, that taxi travel is considered entertainment fringe benefits as well. Now, entertainment is two types, meal entertainment and recreation. We're talking about meal entertainment for now. Now, not all provision of food and drink is considered entertainment. Things like sustenance, for example, coffee, tea, biscuits, cookies at work are considered sustenance. They're not considered entertainment, so not subject to FPT. They're there to make sure the employee gets through the day with ease. Meals whilst traveling overnight is otherwise deductible, so it's not considered entertainment. Uh, Light meals under $15. Look, this threshold's been fluid lightly because you can't get much under $15 these days. But the concept is if you are buying a sandwich or a coffee and there's no entertainment in consuming that, then it should not be subject to entertainment fringe benefits. Some people stretch the limit to $20. Some people keep it at $15. So it's basically conceptually, if you're buying sandwiches and coffee, then you should not be subject to entertainment fringe benefits. Any entertainment provided around eligible seminars, which basically go on for more than 4 hours, is also not subject to entertainment fringe benefit. And there is an old ATO tax determination which says if you got appropriate advertising on corporate boxes, a certain percentage of corporate box costs is not considered entertainment. There are a few options to calculate the taxable value of an entertainment fringe benefit as well. The actual method, which does not require any election, where you work out how much of the entertainment expenditure that you've incurred relates to employees and you pay FPT on that. The other two methods for which you require election is the 50-50 split method and the 52-week register method. 50-50 split method is basically all the entertainment expenditure you dump into a bucket and half it and report it in your FPT return. It does not distinguish between entertainment provided to employees or entertainment provided to outsiders. With the 12-week register, you just maintain a register to work out the pattern of entertainment expenditure and then calculate your entertainment taxable value accordingly. Now, something to note here is if you are providing salary package meal entertainment benefits or entertainment leasing facility benefits, then you don't have an option of 50-50 or 12-week register. You have to choose the actual method and the amount has to be reported in an employee's payments income statement. Some exemptions could apply to entertainment benefits. One of the most common ones we see is minor infrequent. Now, something to be mindful of there is there's a $300 including GST inclusive threshold, and the threshold applies to each separate benefit provided, but it also considers the associated benefits provided during the year to the employees. And the most important one, this three minor infrequent benefit exemption is not available for entertainment benefits provided by income tax exempt entities. So all not-for-profits would not be entitled to use the minor benefits exemption for entertainment benefits. As discussed earlier, various capping thresholds apply to not-for-profit entities and certain benefits don't have any capping limits. It is important to remember that whilst ordinarily, meal entertainment is not reportable and is not subject to any caps. When salary sacrifice, it becomes reportable and has a separate $5,000 cap if you are a not-for-profit organization. Portable electronic devices. Now, we're getting quite a few questions on this topic recently, so just thought we'll cover this one. So portable electronic devices, there's a specific exemption within the FPT Act that says portable electronic devices provided to employees would be not subject to FPT provided it meets certain conditions. Primarily intended for business use, small, light, and portable, designed for use away from the office environment, and can operate without a power supply. The last one, which is the most important one, is it is designed as a complete unit. Now, common examples of portable electronic devices is mobile phones, laptop, printers, and there is a restriction on one item per FPT year for items that are substantially identical to each other, unless it's a replacement item. Now, we've listed some of the common questions we've been asked slightly on specific devices. First one's earpods, whether it is whether it qualifies for the exemption. So we've gone through the test. Yes, it is a portable electronic device. It whether it's substantially different to a headset that you've been provided from work, don't think so. And whether it's primarily intended for work purposes, now it'll depend on the person's situation. Most likely we'll say no. Second one is a smartwatch. There's a tax ruling in which the commissioners rule that the functions between a mobile phone and a smartwatch are substantially different. So it is a portable electronic device. Does it have substantially different function to a mobile phone? The ATO is ruled to say yes, and the reasons where the watch can receive and display text messages and emails, but sending and replying is quite a limited functionality. The watch cannot download or use majority of the mobile phone applications, and the watch is not capable of viewing complex web pages on the screen. So it's got some different functionality. That ruling was on a specific watch model. We think the principles are kind of transferable. So with these limitations, the smartwatch was enough for the commissioner to consider that it was a substantially different device. Now, the big question with smartwatches is whether it is primarily intended for work purposes. We're not sure what the answer to this question is. It will depend on your personal circumstances. Now, if you're an athlete and it is really important for you to measure your health and everything on an every 5 6 minute cycle, then it is for work purposes. But if you're not, then it'll really have require careful consideration of the intended for work purpose test. Apple Pencil, yes, it is. Whether it is a portable electronic devices, we think the answer is no. And the reason is it is not designed to operate as a complete unit. It must be paired to an iPad first before it's used. Now, just a quick recap on the administration side of things. Now, declarations should be obtained prior to the lodgement of the FPT return. You can obtain electronic declarations, but and they have to be kept on file for 5 years. Motor vehicle policies and travel policies, look, if it hasn't been revisited in the last 3 to 5 years, good time to look at them and keep them up to date. And whenever you've got employees who are receiving benefits who are not on the top marginal tax rate, is important to consider whether it's a financially better outcome to give them an allowance and get them to make after tax contributions to reduce the overall tax exposure. Not all benefits are reportable. For example, car parking, pooled vehicles, remote area, meal entertainment that's not been salary sacrifice are common examples of benefits that are not reportable. And lastly, the use of software. Look, it is very important to have a good software to prepare your FPT return. Our CTS Plus FPT software is an easy to use FPT software that has inbuilt checklists, declarations, and validations that can significantly ease your FPT return preparation job. It also has electronic lodgement function that allows you to lodge the FPT return electronically so you can take advantage of the extended due date. The 2024 stationery was released yesterday by the ATO to software developers. So we will be releasing our 2024 version of the FPT software next week. Please reach out to any of us if you need to discuss this further or need more information about it.